So if you spend like any time online looking at financial news, you've definitely seen the clickbait.
Oh, yeah. The all caps, flashing thumbnails.
Exactly. The ones predicting that XRP is about to hit $1,000 a coin. I mean, it's designed to grab your attention. And honestly, it sounds incredible.
It does.
But let's just do the raw math on that right out of the gate. For XRP to hit $1,000, its market capitalization would have to reach $57 trillion.
Yeah, which is just, I mean, to put that 57 trillion figure into perspective for a second, you could take the value of every single company listed on the S&P 500, combine them all together, and you still wouldn't even hit that number.
Wait, really? The entire S&P 500?
Yep. You're talking about more than half the value of the entire global stock market, all concentrated into one single digital asset.
Right. So it is entirely gravity-defying. It's basically financial science fiction. So today, we're setting all that clickbait aside and bringing things back to earth. Welcome to the deep dive.
Glad to be here for this one.
Yeah, we are looking at a massive stack of sources today for you. We've got April 2026 market intelligence. We have these really deep institutional analyst reports from places like Standard Chartered, highly granular on-chain metrics, and some very fresh legislative updates straight from Capitol Hill.
And we're synthesizing all of this because, well, the reality of what's happening with this asset right now is far more nuanced. And frankly, it's a lot more interesting than any extreme price prediction.
Exactly. Our mission today is to unpack what is arguably the most fascinating paradox in the entire crypto space right now.
The massive disconnect.
Yeah, the disconnect. On one side of the equation, you have Ripple, the company that builds infrastructure on the XRP ledger. They're experiencing this massive corporate momentum. They're integrating with huge global partners, rolling out new enterprise products.
Right.
Yet XRP, the token, is currently sitting right around $1.44. I mean, that is down over 60% from its 2025 peak.
Yeah, it's a huge drop.
So today, we're going to figure out exactly why that bizarre disconnect exists, how the underlying mechanics of the market are actually functioning, and what specific events could, realistically trigger a breakout.
Because what we're looking at is a classic divergence between corporate fundamentals and actual token economics. To understand why the price remains so stagnant while the fundamental news is honestly so overwhelmingly positive, we have to look at the intersection of recent legal resolutions and what the on-chain data is actually telling us about investor behavior.
Okay, let's unpack this. Let's start with the legal side first, because on paper, the asset has never looked stronger.
Right.
Back in August 2025, we finally saw the end of the grueling 5-year SEC lawsuit against Ripple. They paid a $50 million settlement, the dust settled, and then by March 2026, the SEC and the CFTC jointly classified XRP as a digital commodity.
That was huge.
Yeah. The legal ghost was finally exercised. Regulators are now officially treating it just like Bitcoin.
And that joint classification, I mean, it really cannot be overstated. It provides the exact regulatory clarity that massive financial institutions have been demanding for half a decade.
Exactly.
It means XRP is no longer operating under the threat of being classified as an unregistered security. The foundation is entirely cleared.
Wait, hold on, though. Because if we compare this to the traditional equities market, the math just isn't mathing.
How so?
Say a major tech company wins a massive existential lawsuit that threatened to shut down their entire core business model. Usually the stock pops.
Oh, absolutely.
It flies on that news. But despite this historic legal victory, which is arguably the biggest regulatory win in crypto history, XRP is just hovering around $1.44. Is the market completely ignoring the fundamentals here?
Well, what's fascinating here is that the market isn't ignoring the fundamentals. It's simply being overpowered by raw mechanical supply and demand.
Okay, what do you mean by that?
This is where those on-chain metrics you mentioned earlier become the key to the entire puzzle. If you look at the blockchain data, roughly 60% of all currently circulating XRP was purchased at an average price of around $1.44.
Wait, 60% of the entire circulating supply?
Yep.
Sitting there.
Wow, that completely contextualizes the stagnant price action.
Precisely. Put yourself in the mindset of a retail investor who bought in at that $1.44 level during a previous hype cycle. You watched the asset drop. You watched it languish for months, and, well, human psychology just takes over.
Right, you panic.
The absolute moment the price recovers to your initial entry point, your overwhelming instinct is not to hold for future utility. Your instinct is to sell and get your original capital back. You aren't factoring in the SEC settlement. You just want to break even.
So it's not a lack of interest, it's literally a structural barrier. People often describe this as a weight tied to an asset's ankle, but based on what you're saying, it's actually more like a glass ceiling with an automatic sprinkler system.
I like that analogy. Like, every time the price pushes up to $1.45 and the rally catches fire, this predetermined waves of underwater investors hits the sell button, triggering all these limit orders that immediately put the fire out.
That is a much more accurate mechanical description, yeah. The legal win secured the long-term foundation, but the immediate day-to-day price action is being heavily suppressed by this break-in wall of supply. It is a mathematical barrier created by human psychology.
Man, okay. So if the problem is a massive wall of retail speculators who are selling the very second they break even, the only mathematical way to absorb that sell wall is with buyers who do not care about the daily price fluctuations.
Exactly.
You need buyers who are purchasing the asset purely to use it. Are we actually seeing that structural shift anywhere?
We are, and it's happening at a massive scale in Japan right now.
Okay.
Japan is essentially providing the live, real-world blueprint for how mechanical, utility-driven demand can fundamentally alter an asset's market dynamics.
Here's where it gets really interesting. The sources outline a very specific integration that happened in April 2026. The Japanese e-commerce giant Rakuten integrated XRP into its main payment app.
Right.
And for context, this app serves 44 million users across 5 million merchants in Japan. But they aren't just giving people a button to buy crypto to hold in a wallet. Users can now convert their Rakuten loyalty points directly into XRP to spend at the register. We are talking about a $23 billion loyalty ecosystem.
The mechanics of this are what make it so significant. When a consumer at a grocery store decides to pay using their Rakuten loyalty points, the back end of that app programmatically executes a market buy for XRP, transfers it across the ledger in seconds, and settles with the merchant.
Wow.
The user doesn't even have to know they are using blockchain rails. It is a seamless integration of digital assets into everyday consumer flow.
But let me push back on the scale of this for a second. We are still talking about an $88 billion total market cap for XRP.
Yeah.
Even if 44 million people are occasionally buying a coffee or, I don't know, a pair of headphones with Rakuten points, is that relatively small retail volume actually going to move a market that massive? Or is this just a really brilliant PR move for Rakuten to look technologically advanced?
Well, it's less about the immediate volume spike and more about the structural shift it represents. You're moving XRP from being a purely speculative token, where the only reason to buy it is hoping the price goes up, to an asset with a fundamental utility floor.
Okay, I see.
It creates consistent, non-speculative buying pressure, and crucially, this retail integration is happening concurrently with a massive regulatory shift from the Japanese government.
Right. The sources note that Japan's Financial Services Agency, the FSA, is currently preparing to reclassify XRP from a standard crypto asset to a regulated financial product by the second quarter of 2026.
Which is a profound change in legal taxonomy. By categorizing it alongside traditional stocks or bonds, it opens the door for institutional capital. Japanese pension funds, which manage trillions of dollars, operate under strict mandates regarding what asset classes they can touch. A crypto asset is usually off limits. A regulated financial product is not.
That makes a huge difference.
Exactly. Furthermore, it potentially lowers the capital gains tax on the asset for regular citizens to a flat 20%, bringing it in line with traditional equity investments.
So Japan is essentially building the retail utility engine while simultaneously laying down the regulatory highway for institutional capital.
Perfectly said.
But that naturally begs the question. If retail utility is the stepping stone, institutional adoption is the ultimate destination. That is where the trillions of dollars actually live. And yet, looking globally, institutions are still heavily hesitating to use XRP for its primary intended purpose, which is cross-border payments.
They are. And to understand why, you have to look deeply into the mechanics of how global banking currently operates, specifically regarding SWIFT.
Right. So what does this all mean? Ripple's CEO, Brad Garlinghouse, has been very public about his goal to capture 14% of SWIFT's cross-border payment volume.
Yes, he has.
And purely on a technological specification level, the math is entirely in Ripple's favor. XRP settles transactions on its ledger in 3 to 5 seconds, costing fractions of a cent.
Right.
SWIFT, which is the legacy messaging system banks use to talk to each other, takes anywhere from 1 to 5 days to settle and charges $25 to $50 a wire.
The inefficiency of SWIFT is really rooted in its reliance on Nostro and Vostro accounts. To facilitate global transfers, a bank in the US has to pre-fund an account in a partner bank in Europe with euros, and the European bank has to pre-fund an account in the US with dollars.
Yeah, the sources compare this to a traveler having to leave a pile of physical cash in every single airport in the world just in case they decide to visit that specific country one day.
Exactly.
It traps billions of dollars in dormant capital globally just to provide the necessary liquidity for transactions. And XRP is designed to fix that by acting as an on-demand bridge currency.
Right, you don't need the pre-funded accounts.
You just instantly swap dollars to XRP, move it across the world in 3 seconds, and swap XRP to euros.
On paper, it is a vastly superior technological solution that frees up massive amounts of corporate capital.
But here is the disconnect. If XRP is the high-speed fiber optic internet and SWIFT is literally a fax machine, why aren't the banks instantly ditching the fax?
Well,
Because when you look at the on-chain data, the actual institutional transaction volume utilizing the XRP ledger for cross-border payments has remained relatively static. Why the hesitation?
if we connect this to the bigger picture, you have to put yourself in the shoes of a corporate treasurer at a major multinational bank.
Okay.
Your absolute primary directive is risk management. You do not care about the elegance of the technology if it introduces new risk. Yes, an XRP transaction settles in 3 to 5 seconds, but during those 5 seconds, the asset is subject to the open market. If you are moving $500 million across the globe, and the price of XRP drops by even 0.1% during that 3-second transfer window, your institution just lost $500,000.
Wow.
That is called currency risk, and corporate treasurers despise it.
So the volatility of the asset itself is the main barrier to its utility. That perfectly explains the bear case outlined in the analyst reports, which targets a price drop down to around 95 cents or $1.20.
Right.
The bears argue that because institutions hate volatility,
Right.
when they finally do move to blockchain rails, they are going to exclusively use stablecoins. Even Ripple seems to acknowledge this reality, considering they just launched their own stablecoin, RLUSD.
Exactly. Ripple launching RLUSD, which quickly hit a $1 billion market cap, is a pragmatic move to capture the institutional volume that refuses to touch a volatile asset.
Makes sense.
But it puts XRP, the token, in a difficult position. It is currently fighting a two-front war. On one side, it is battling the entrenched legacy system of SWIFT, which, despite being slow, is universally trusted and actively upgrading its own technology.
Right.
On the other side, it is fighting modern stablecoins like USDC and USDT, which offer the exact same blockchain speed as XRP, but completely eliminate the price volatility that terrifies those corporate treasurers.
And that institutional fear of volatility is showing up vividly in the ETF data right now.
Yeah.
We have 7 spot XRP ETFs actively trading, holding about $1 billion in total assets.
Yeah.
But the breakdown is stunning. 84% of that capital is from retail investors, and only 16% is institutional. If you contrast that with the Bitcoin ETFs when they launched, they were immediately dominated by institutional capital flows. The big money just isn't biting on XRP yet.
The retail market is buying into the future potential of the infrastructure, but institutional capital requires perfectly aligned risk parameters and absolute legal certainty before deploying billions of dollars. And that certainty hasn't fully arrived in the United States yet.
Which brings us to what actually forces their hand. If the technology alone isn't enough to make institutions adopt it at scale, the catalyst has to be Washington, D.C. Let's look at the legislative landscape, specifically the Clarity Act.
Right. The Clarity Act is the legislative vehicle designed to permanently codify the regulatory status of digital assets in the U.S. It's scheduled for a markup by the Senate Banking Committee in late April 2026.
But the sources point out a major snag. According to Polymarket odds, the chances of the Clarity Act actually passing have dropped down to 54%.
Yeah, the odds are slipping.
And the fascinating part is that this delay has absolutely nothing to do with XRP itself. The bill is an omnibus package, and it's being stalled by political squabbles within the committee over completely unrelated issues. Specifically, how to regulate decentralized finance, or DeFi, and how to handle the yield generated by stablecoins.
Right.
Because it's all packaged together, XRP is caught in the legislative crossfire.
And that gridlock has direct, quantifiable consequences for the asset's valuation. We saw Jeffrey Kendrick, the head of digital assets research at Standard Chartered, drastically adjust his models based on this. He cut his 2026 base price prediction from $8 all the way down to $2.80, citing these macro and legislative headwinds.
But his upside scenario is wild. He explicitly noted that if the Clarity Act does manage to pass and that regulatory green light triggers just $10 billion in institutional ETF inflows, his target goes right back up to $8.
It's a huge swing.
It's like you are holding a VIP ticket to an exclusive event, but the bouncers are outside arguing with the promoters about a completely different event's dress code, and they just refuse to open the doors.
That's a great way to put it.
And while we wait outside for Congress to act, we have to address the other massive elephant in the room that dominates the on-chain data, which is Ripple's escrow.
Yes. The escrow mechanism is arguably the most fiercely debated and widely misunderstood aspect of XRP's entire supply dynamic.
I see the panic on financial forums constantly about this. Every single month, 1 billion XRP tokens unlock from a cryptographically secured escrow.
Right.
And the narrative online is always about Ripple, quote unquote, dumping 1 billion tokens on the retail market and artificially suppressing the price. So let's look at the actual mechanics here. Is this monthly unlock fundamentally keeping the price at $1.44? Or is it just a convenient scapegoat for a market that is frustrated waiting on Congress?
This raises an important question. When you analyze the programmatic reality of the escrow, the dumping narrative completely falls apart. Yes, the smart contract unlocks 1 billion tokens on the first of the month. However, historically and consistently, Ripple immediately relocks roughly 70% of those tokens back into new future escrows.
Oh, wow. Okay, so they aren't dumping 1 billion tokens. The actual net addition to the circulating supply is roughly 300 million XRP a month.
Exactly. It operates as a highly predictable algorithmic inflation rate. Professional market makers, institutional algorithms, and large-scale investors have entirely priced this 300 million net addition into their valuation model.
Yeah, right, they already know it's coming.
Exactly. It is a known supply framework, not a sudden, unexpected market overhang. Furthermore, if you look at the real-time wallet data, whale accounts, the largest individual investors, they're currently accumulating XRP at a rate of roughly $9 million every single day.
Let's do the math on that.
Okay.
At $1.44 a token, that 300 million newly introduced supply equates to about $432 million worth of XRP entering the market a month.
Right.
If whales are buying $9 billion a day, they're scooping up $270 million a month.
Yep.
So the largest investors are actively absorbing well over half of that newly unlocked supply right off the table.
Yep.
The escrow clearly isn't what's holding the price back.
It's not. The data firmly points back to Washington. Institutional surveys heavily corroborate this. Currently, 65% of surveyed financial institutions explicitly cite regulatory clarity as the single remaining hurdle preventing them from increasing their exposure to digital assets like XRP. The binary event that will make or break the valuation in 2026 is entirely legislative.
We have covered a massive amount of complex ground today. Let's synthesize this core tension so you can see the full picture. XRP in April 2026 is an asset with undeniably incredible infrastructure potential. It is being actively utilized by massive global players like Rakuten to settle real-world commerce. Top-tier financial institutions are structuring ETF products around it.
And the legal cloud from the SEC is completely gone.
Right. But it is temporarily trapped. It is squeezed between a massive psychological break-in wall of underwater retail investors who just want to sell and a gridlocked U.S. Congress that is delaying the final regulatory green light institutions need to actually step in.
We are observing a textbook example of a deep transition phase. The legal era of endless courtroom battles and existential threats is officially over. We are now navigating the incredibly messy, highly technical early stages of the institutional era.
And for you listening, this is exactly why doing this kind of deep dive matters. You aren't just staring at a stagnant crypto chart. You are watching the real-time, highly complex evolution how global financial rails are actually upgraded.
Yeah, it's fascinating to watch.
It is an absolute masterclass in separating the corporate success of a company like Ripple building partnerships from the actual token economics and market mechanics of an asset like XRP.
Understanding the distinction between a company's software sales and the open market demand for a utility token is a vital skill for anyone trying to navigate the digital asset space intelligently. Utility and corporate partnerships are essential foundational pieces, but until they translate into mechanical, on-chain demand that absorbs the available supply, the valuation will lag.
Absolutely. I want to leave you with a final provocative thought straight from the intelligence reports. We spent a lot of time today talking about XRP fighting SWIFT and fighting stablecoins for a share of commercial banking transfers. But Ripple is currently partnering with central banks in places like Palau and Montenegro to help them develop central bank digital currencies, or CBDCs.
Which introduces a completely different scale of financial infrastructure. Moving money between two commercial banks is one thing. Facilitating the monetary policy of a sovereign nation is another entirely.
Exactly. At the very beginning of this deep dive, we talked about that gravity-defying clickbait prediction of $1,000 and how the massive math of a $57 trillion market cap brings us quickly back to Earth. But here's something to mull over. What happens to the fundamental valuation models of XRP if it stops being just a high-speed tool for commercial banks to move money and instead becomes the core interoperability bridge for sovereign nations exchanging entirely new digitized national currencies?
That changes the math completely.
If it becomes the rails for entire countries, maybe the math really does change completely. Let that thought sink in until our next deep dive.